Good afternoon and welcome to everyone to this, our Parkwell webinar on ESG reporting. A couple of bits of admin just before we start. First of all, the session is going to be recorded this afternoon, and the recording and the slides we're using during this session will be uploaded to our website over the next few days. And also we have a panel session during this session. And if you have any questions that you want me to pose to the panel, please feel free to use the Q&A functionality within Zoom to post any questions. So can I have the next slide, please? So my name's Jason Rakes and I work for Parkwell. We are a mid-tier firm of management consultants. We are based in the City of London, and we have a particular focus on the financial services sector, and within that, the wealth management sector. Indeed, many of you will probably know our sister company, Compare, who provide benchmarking data and services to the wealth management industry. As a management consultancy, we have a team of consultants, all who have considerable experience within the wealth management industry, helping clients deliver either business process change through systems and process implementation, and indeed executing projects to address regulatory change. Over the last, I guess, dozen plus years, what we've seen within the industry is that the burden due to regulation has increased dramatically, with things like MiFID II, and GDPR being probably two key bits of regulation that we've had over the last dozen or so years. Can I have the next slide, please, Nick? Just to give you a flavour of the nature of the clients we work with, as you see, we have a broad brush of clients, from some of the very large players to some of the more niche firms within the industry. Can I have the next slide? So our schedule for this afternoon is obviously I'm doing the welcome and the introductions. We're then going to have Tim from PIMFA, who is going to give us PIMFA's perspective on ESG reporting and investing. We then have my colleague Ian, who's going to talk about how to address ESG reporting and how to deliver a project to deliver that ESG reporting. We then have our panel discussion, and I'll introduce the panelists as and when we get there. And then I'll wrap up at around about 5 o'clock. Next slide, please. So just to set the scene very briefly, what is our current state at the moment? Well, we, through Compare, have conducted a little bit of research, and what the firms tell us within the wealth management industry is that most of them now have some form of ESG product offering. So clients can engage with them and have some form of ESG investment strategy with them. However, there are still many of those firms which have not yet implemented ESG reporting. So from my perspective, that leaves a little bit of a gap in that how can you tell how ESG a firm is, and how can you compare one firm's offering to another firm's offering? So I don't think that's been helped in a great deal, in that while the EU has defined a set of regulatory requirements within ESG, here in the UK, as a result of Brexit, we're not obliged anymore to implement those EU regulations, and indeed the FCA currently has chosen not to. So there's no formal requirement to do ESG reporting. However, it's very rapidly becoming a must-have within the industry, and clients are becoming to expect it, and therefore firms in the absence of that regulation are having to make up or to second guess what clients might want to see, and that leads to a number of issues that sometimes the measures that are adopted by different firms aren't comparable across the industry. So I think that gives us a little bit of background to where we've got to with ESG reporting. And I'd now like to invite Tim to give us PIMFA's perspective on this, please. Over to you, Tim.
Thank you very much, Jason, and thank you to all of those who have joined us this afternoon. My name's Tim Fassam. I'm Director of Government Relations and Policy at the Personal Investment Management and Financial Advice Association, which is the trade association for the wealth management and financial advice industry. And ESG has been a significant part of our work for the reasons Jason set out. This is now becoming a mainstream part of our market with increasing customer interest. And because of that increased exposure and other government objectives, we're seeing significant changes to regulation and legislation that affect how we can offer these sorts of products and services to customers. And because climate change does not pay any attention to international borders, nor does carbon, much of this happens in an international context. And so what I'm going to try and do today is give you a sense of that international context, what's happening, what are the trends, where have we got to in the UK, and then what do we think at PIM for the industry can do to seize the opportunity this represents. So can I have my next slide, please? So this all hinges the global agreement on climate change on the Paris Agreement, which the US has recently rejoined after Donald Trump left. At its heart, it aims to reduce global greenhouse gas emissions and limit global warming to less than 1.5 degrees. It's 196 countries in this agreement, and they're looking at how they can develop a global legislative framework to meet these goals. The G7 meeting that you may have seen media coverage of in Cornwall reaffirmed this committed to strengthening and accelerating its implementation through national policies and international cooperation. Much of this is driven by commitments to reduce emissions and meet a net zero target. And you can see the examples in other major economies, but in the UK, we've committed to a reduction of 68% by 2030 as part of a commitment to a net zero target by 2050. Now, the thing I would mention here is we have already done most of the easy things in terms of carbon reduction. This will mean, if we are going to meet it, significant change to ways of working, to social structures and to the economy. And importantly, it is going to mean an enormous amount of investment being focused on not just ESG compliant, but carbon reduction technologies. And so this is going to, if the government really are serious about this, this is going to dominate industrial strategy and the global and UK economy for the coming years. Can I have the next slide, please? So how is this being managed at a global level? Well, this is predominantly being done through the Task Force on Climate-Related Disclosures, which was created by the Financial Stability Board, which you'll remember from the financial crisis as the main way that central banks, treasury departments, finance departments of governments get together to agree global financial regulation. And these disclosures will be used by companies, banks, investors to improve and increase reporting of climate-related financial information. And it's becoming a global standard with over 100 regulators and governments supporting it. They're looking at disclosure in 4 areas, an firm's governance, which will involve describing how the board and management assess and manage climate-related risks and opportunities. Strategy, whereby they include descriptions of the organization's resilience to different climate-related scenarios. Risk management, where they disclose the process for identifying, assessing and managing climate risk, including how it links to overall risk management strategy, and then the metrics and targets that they will they use to assess and manage climate risk and their performance against those metrics. And I'll come back to this a little bit later, because this is what is setting the tone for the global debate and the UK debate. Can I have the next slide, please? So what's happening in the EU? Well, the EU has been leading the sustainable finance agenda globally through the adoption of an ambitious and comprehensive package of measures aimed at improving the flow of money towards sustainable activities. And this, because this is having such an influence on the global agenda, it's worth being aware of, though, as Jason says, this will not, the government has decided, the UK government has decided not to implement these regulations. So first and foremost, the Sustainable Finance Disclosure Regulation, which has been in force since March, and are required to make pre-contractual information on websites and reports include consideration of sustainability risk, including the risk of depreciation due to environmental or social events, consideration of principal adverse impacts on sustainable measures. These are negative effects on environment, social and employee matters, as well as respect for human rights, anti-corruption and anti-bribery resulting from investment decisions. And then sustainable investment that contribute to environmental, social objectives. And this is really the phrase you may have come across quite frequently, the work on the EU taxonomy eligible economic activities. These have to contribute to one of 6 environmental objectives that they set out in legislation, do no harm to any of the others, comply with a set of governance standards, and then there are specific scientific thresholds and technical screening on carbon amounts to become eligible. If we move on to the next slide, what are we doing in the UK? Well, as I said, the UK decided not to ensure the 2 big legislative measures, the SFDR and the taxonomy, but it has been very clear that it wants to match the ambition of the EU Sustainable Finance Action Plan that the SFDR is part of. So last November, the Chancellor announced his intention to position the UK at the forefront of green finance. It's confirmed the UK will become the first country in the world to make the TCFD disclosures, which we talked about earlier, fully mandatory across the economy by 2025, which goes beyond the comply or explain approach that most other governments are looking at. They will then implement their own green taxonomy, so their own common framework for language and assessment on environmentally sustainable investments. And this will use the scientific metrics from the EU taxonomy and then have an UK-specific Green Technical Advisory Group who will review these metrics to ensure that they're appropriate for the UK. Can I have the next slide, please? So what has happened recently? Well, hot off the press on the 22nd of June, the FCA announced that it's consulting on its own climate-related disclosure rules and guidance for asset managers, life insurance and pension funds. The FCA has proposed a disclosure regime that is consistent with TCFD, which has not surprised anyone, and it will be effective from the 1st of Jan 2022 for large firms, and then 23 for smaller firms, for the other firms. The key elements are entity level disclosures, where firms will publish annually entry-level TCFD report on how they tackle climate-related risks and opportunity, take climate-related risks and opportunities into account in managing investments. And then product or portfolio level disclosures, which again are they'll annually produce a baseline disclosure in respect to their product and portfolio, including a core set of agreed metrics. We also now have the names of the UK Technical Advisory Group. They will be independent, but it will be non-binding advice to the government on how to implement a taxonomy. And the aim here is to particularly clamp down on greenwashing and provide better data for better decisions by companies, investors, and consumers. Can I have the next slide, please? And this is just a few thoughts from PIMFA on why this matters and why this is important to get right, beyond the fact that it's a regulatory requirement. And the first one is consumer demand, and customers are increasingly interested in aligning their investments with their personal values. And that means there's a clear competitive advantage to getting this right and going above and beyond, because this isn't niche. And importantly, it no longer necessarily means lower returns. And our view is that, in particular, if you're looking at long-term investments, you absolutely have to take climate-related risks into account, not least because the commitment to net zero means that any polluting investment or non-ESG investment is likely to come under significant pressure from the government. The innovation in this space means that increasingly customers can have the best of both, because climate-related innovation is in itself potentially going to be very high return. How can you particularly attract customers? Well, partly it will be helping them differentiate between the E, the S, and the G. Environmental is reasonably straightforward in some ways. When we talk about carbon's a measurable output. Social and governance are much more of a value judgment and really will depend on the individual preferences of the investor. What can we do as a sector? Key is trust. If customers do not trust us to deliver a genuinely sustainable investment portfolio, they will not invest with us. And that means we have to develop measurable standards and reporting that go beyond the minimum requirements and include investment outcomes. We need greater consistency because fund names, objectives, investment strategies are not always well aligned, and it's hard for customers to compare. We need absolute clarity and transparency and consistency in terminology and approach to boost customers, and we should all push back against greenwashing, which will fundamentally undermine that customer trust, which is so at the heart of everything we're trying to achieve. So in short, the ESG agenda is one of the biggest challenges and opportunities on the table for our industry and for the public. And directing future investment into these areas in the long term is incredibly important to all aspects of society. And this can't be done just by institutional investors. The personal investment sector is absolutely critical to harnessing the opportunity that ESG investing presents. And we just need to make sure we follow these watchwords: clarity, consistency, proportionality, and simplicity. I hope that's been a helpful overview. Thank you very much, and I will pass to the next speaker. Thank you very much.
Thank you very much, Tim. That was very enlightening. And while there's no regulation at the moment, there's obviously some stuff coming down the track in our direction. So our next speaker is Ian White from Parkwell, and he's going to explain to us how to implement ESG reporting and some of the natures of the measures that you might choose to implement, and indeed some of the things you need to look out for. So over to you, Ian.
Thanks very much, Jason, and thank you, Tim, for those slides. And I'll pick up on a couple of those points, hopefully, as I walk through. If we can move on to the next slide, please. So just to introduce myself, I work for Parkwell and have done for 20 years now, delivering change, specialising in the wealth management industry, and there's some names and acronyms there that you'll be familiar with. Most recently, I have been working with a global wealth management firm on their ESG programme, amongst other things, so have an insight into what the industry is looking like at the moment in terms of ESG strategy and delivery. Next slide, please. What I wanted to talk about today was perhaps to dig down into a little bit more detail about what's possible at the moment and what the future options are for setting up reporting at a detailed metric level for your clients. And as Tim mentioned, the FCA have recently, or last week, produced their long-awaited consultation paper on their initial ESG requirements. Again, as Tim mentioned, it drives down the TCFD disclosures, and it's looking for annual disclosures at a corporate and at a portfolio level. I think my view is a lot of firms will be going over and above that already, especially for their ESG specific portfolios. And I think perhaps the FCA are lagging behind what a lot of leading firms, or at least the cutting edge of the leading firms, are delivering at the moment. So the question really is what's available to report, what the possibilities are, how they can, and what are the detailed steps that can be taken to deliver those. Next slide, please. So the question here is, why should we be looking to provide ESG metrics and ESG reporting to your clients? I'd start off by saying the start point needs to be an overall ESG strategy for your firm. Really important that as an investment firm, you understand internally, before you provide anything external, you understand internally what you're looking to produce, what your overall strategy is for ESG. Is it a specific set of ESG products? Are you going to aim to be ESG compliant for your entire investment universe? How are you going to communicate that to clients? Once you're clear what that is, you've got an opportunity now to be able to introduce ESG metrics into client reporting to be able to back up and evidence your commitment to that strategy. And that will give a lot of benefits, both for your clients, but for you as a firm. It will help you demonstrate that you're walking the walk as well as talking the talk. It will hopefully start to introduce a virtuous circle whereby once metrics are reported to clients and are available in black and white, there's a record there. You will start to be judged on those, which may sound scary, and perhaps it is a little bit scary, but what that will do is really introduce the imperative and the drivers for your investment team to start taking ESG considerations as seriously as all the other considerations that go into the investment decisions. And I think that's really important, and that will really help embed ESG across your firm. And as Tim mentioned, this isn't going away. This is only going to grow, and it is a commercial question now, a commercial differentiator. So the more you can ensure that this is embedded and in place in your firm, the better positioned you will be to take advantage of that with your existing clients and with your prospects. And by delivering reporting and by making reporting available, you can really have that discussion with your clients and with your prospects and really demonstrate your commitment. And you will get ahead of the curve for regulatory change. The FCA talk about their ESG source book that they're starting to work on, not available yet, but that's mentioned in the consultation paper. And I think it's clear there's going to be further requirements and further regulations downstream that will be along the same level or aligned with the EU, even if not taking the EU requirements word for word. So a number of reasons why to do it. If we move on to the next slide, please. What's available to report? I think the most obvious and simple one that's out there is carbon emissions. All firms are required to, of a certain size, are required to identify their or to report their carbon emissions. Those are reported or available in a number of market data feeds. So it's reasonably straightforward to take those carbon emission numbers, run the calculations against the share capital of the firm and the share price, and then how you can deliver a carbon emissions number that can be directly attributed to the direct equity investments in a client's portfolio. Where that gets a little bit more complex is for funded investments, because funds don't necessarily produce those specific numbers, but with look-through data, again, available from data feeds, if you use that, you can provide or you can run those calculations to understand carbon emissions for funded investments as well. Carbon emissions is obviously only one part of ESG. There are a number of other metrics available depending on your market data feeds. And some larger firms I know have prepared in-house proprietary systems that have a wide number of additional ESG metrics available. So whatever's available to you as a firm, you could consider adding that to your reporting. But really important that as a firm and for your client-facing teams, you understand what you are reporting to your clients and you understand what the drivers are behind those. And that's not always quite as simplistic as you might think. For example, carbon numbers are normally given against a dollar value. If your portfolio is in a different currency, obviously you have an FX rate risk there that could potentially make the carbon emissions number move, even though it's an FX rate that's actually driving that. So all part of the understanding that needs to be in place to be able to have sensible and realistic conversations with your clients. If we move on to the next slide. So personally, I think there's three levels here that need to be provided. The obvious and perhaps the simplest one at this stage is carbon emissions. You then have what I've called level two, the additional social and environmental metrics that are available now. And then I think there's a third level, which again, I think has been alluded to already, customized metrics, whereby you are asking your clients or getting your clients to pick what they think the key, what's really important to them from an investment and perspective, and then you can provide them with those metrics so they can see how well you're doing against their ESG goals as well as their overall financial goals. Now, I think we're a way away from that at the moment, both from a functionality level and from a data level, but I don't think that's a million miles away, and I think it's going to be, you know, a couple of years maximum whereby that will be required to be at the top, at the cutting edge or the top echelon of ESG firms. The only other point I'd make on here is that I've got a separate two columns there, the portfolio numbers, but also a benchmark number. If the client doesn't have anything to compare to, these are just numbers on a page. You need to be able to provide some sort of benchmark, some sort of standard figure, so you can compare both internally from an investment perspective and also from a client perspective. Okay, next slide, please. So how do we do this? In theory, it should be a reasonably straightforward calculation process, but obviously that's dependent on what's available from your market data feeds, what's available from a look-through perspective, what you believe benchmark figures should be presented, and then the level of customization or configuration that's available from your current investment and reporting systems, which for different firms will be a different challenge. Some firms, this may be an internal IT task that's required. Other firms, you might need to talk to your outsourced providers or your system providers. The only other point I make on this slide is the quality of the data. I think currently this is not the most mature data set that's out there. There are challenges, there are potential errors or certainly anomalous figures that are potentially reported. You need to have your processes in place to be able to manage those in the same way you'd manage a price feed, so that you are making sure you're smoothing the data and any anomalous figures are not getting through to the end reporting. Okay, thanks. If we move on to the next slide, please. So a couple of points on how to implement this. It does need to be taken seriously as a significant project. Whenever anything's being prepared on an external basis or being sent out to clients, you need to ensure that this is a accurate, well presented, audited, quality data that's being presented. So you need the skills on the project to deliver that, whether that's internally or external. You just need to make sure the right people are available to deliver that. Next slide, please. So finally, just to mention Parkwell, and I know Jason covered us very quickly at the start of the presentation, but Parkwell do have experience in delivering change across the wealth management area. We understand what the challenges are and the opportunities are for ESG projects, and we can help at a number of levels, whether that's just an initial impact assessment and planning process, or full service program and project management, or indeed just assisting with your in-house team to provide oversight and guidance. We do have a track record of successful delivery, and we believe we have the methodologies and the quality in place to assist. Okay, that wraps up my slides, so I'll hand back to Jason and the panel members. Thank you.
Thank you very much, Ian. I thought that was, again, a very useful insight in how to go about implementing ESG reporting. So as Ian pointed out, we're now onto our panel, and we have three excellent panelists, and I'm going to ask each one of them to introduce themselves very shortly. Obviously, we've already met Tim, so I'm going to skip on him from now. But Kate, would you like to introduce yourself and a little bit about what your firm has done around the ESG space, please?
Hi there, yes, you can hear me. So my name is Kate Rogers. I am Head of Sustainability at Cazenove, and I look after the sort of sustainability capability for the global Schroders Wealth Management organisation. What have we done? We've done an awful lot on sustainability and also on impact reporting, and so I look forward to sort of sharing some thoughts on what best practices, but we made the significant step at the beginning of this year to report impact metrics to all of our clients, personalised impact metrics to all of our clients across the world. So that's what we're doing now, but delighted to be here.
Thank you very much, Kate. And we also have Patrick Thomas from Canaccord. Patrick, do you want to introduce yourself and again a little bit about what Canaccord has done around ESG reporting, please?
Yeah, sure. I'm Patrick. I'm head of ESG investing, and I set up our ESG proposition back in 2017. So yeah, we've done a lot around kind of how we implement ESG as a firm from an investment perspective. And also quite a lot from a kind of reporting and also internal kind of policies and procedures stuff. So hopefully I will share some insights and speak to you all about it. So thanks a lot for having me.
Thank you, Patrick. And our third panelist is Tim, and as I've already said, we've already met Tim. So let's get on to the questions. So my first question to the panel is, in your experience, which metrics are clients most interested in? Should we start with Kate, please?
Yeah, I mean, I think we're showing quite a range of metrics to clients, and it sort of slightly depends on what their level of interest is. But in general, the climate change real world metrics are the other things that resonate most, particularly when translated into equivalencies. So, you know, if you're saying your portfolio has this number of metric tons worth of carbon emissions, which is say 10 metric tons less than the global equity benchmark, that translates to 10 flights from London to New York in terms of reducing your carbon footprint. So I think it's the meaningful, tangible impacts that we find resonate best with the clients, much better than the sort of slightly abstract scores that many of the you know, ESG providers would pipe through into valuations or into portfolios. So what we try and do is very much translate it into real world impact metrics.
Okay, Kate, do you allow your clients to pick and choose which metrics they are delivered?
So yeah, we have sort of baseline metrics that go to everybody.
Right.
Then we have more detailed metrics. Yes, that are tilted towards the client values.
So if a client they choose from a menu, yeah.
So if a client says that they're interested in a specific sustainable development goal, like for example, gender equality, then what we would surface to them in their reports would be the action that we've taken to progress gender equality, and that might be data on the portfolio components that have women leadership. That might be action that we've taken in terms of the use of our influence in writing to companies with all male boards, for example.
Okay, thank you very much. And the same question to Patrick. Do you want to repeat the question, Patrick?
You were asking about what reporting metrics that I think are the most important. Was that the
Yes, correct.
Yeah. So I guess from my role, I mean, I run a portfolio service that's entirely thematic, focused around the SDGs. So the reporting that we provide for that is really quite focused kind of impact reporting around what the portfolio is invested in, and how much of a contributory the component parts are to the various goals. So for that service, we have quite different reporting to clients not invested in that service. I think for clients not invested in that service, they tend to get some data around carbon emissions, but generally we don't bombard them with data around ESG in their kind of formal reporting.
Okay, thank you very much. And Tim, from a PIMFA perspective, do you get any insight into what you see clients looking for in terms of ESG reporting?
I think the challenge to perhaps take it in a slightly different direction is there is always going to be a bias towards communicating what's measurable. So the Millennium Development Goals or the carbon figures. And I think where it gets trickier is where there are sort of real value judgments that are individual to the customer. But for some customers, they are going to be particularly important to them. And one of the examples we've used before as a controversial issue, for some investors, they would not consider a fund ESG compliant if it invested in Israel. And for some investors, they wouldn't consider it compliant if it boycotted, because that's a personal view on a controversial and complex issue. And so how the industry develops to take into account those much more subjective elements will be a really interesting and important development. But within regulation, I think we are certainly keen to ensure that we're focused on, measurable disclosure that is comparable and consistent.
Okay, thank you very much, Tim. Let's move on to our next question. This is to Patrick. So do you see clients changing their investment behavior as a result of ESG metrics?
No, I don't think they're changing their behavior as a result of ESG metrics at all. I think if you had asked your average retail client what they understood by the acronym ESG, it's pretty minimal. I think that generally investors are moving to ESG focused investments primarily because they can see a performance kind of advantage in doing so. And to a degree, I think there's a kind of generational shift to kind of aligning investments along those lines as well. But yeah, I honestly, I think if you ask your average kind of retail client whether they've moved as a result of seeing some scoring from a analytics company, the answer is no.
Okay, and when you say performance, you're talking about financial performance. You think that the financial performance is generally better from an ESG type offering?
Well, look, I'm going to be biased, and I would say that, so trust your instincts on that one. But I would look, clients for years and years have performance chased. So if they are in an environment where they can see a 3 and 5 year number where it's clearly been advantageous to be adopting this kind of strategy, they're doing so. So yeah, we're seeing a lot of interest from people actually who are doing this as an investment thesis rather than as a kind of moral judgment call.
Okay, thank you very much. Tim, what is your perspective on that from PIMFA's viewpoint?
So I think we're seeing customers being motivated by a whole range of issues. As Patrick says, there is a generational interest in climate and climate disclosure, and there is, particularly over the long term, I think, a very sound investment thesis that decarbonisation is going to be a growth part of the economy. I think in terms of really about disclosure, I mean, this is really an issue that goes well beyond ESG, and we're talking to the FCA at the moment about a number of the disclosures within MiFID. If someone is engaging with ESG through a financial advisor, they have probably said, you know, I want my investments to support, you know, to be environmentally friendly, and I want them to be socially conscious. In the same way that they would give their advisor or their wealth manager any other set of objectives. At that point, they largely trust the firm they're working with to get on with it. Now, disclosure is important for verifiability and trust, but they're largely expecting their advisor to do that for them. If they have you know, in the MiFID discussion, they expect the advisor to be checking the fees, the charges, the return, and the same on many ESG. You know, we need to be transparent, to be clear, but this is why they have engaged with an ESG specialist, potentially, whether that's through an investment house or through an advisor, because they don't want to be going through that data and making those decisions individually in many cases.
Okay, so it's more like a one-off selection. I'm going to choose a service provider and then go with them for their advice. Yeah, okay then. Thank you very much, Tim. And Kate, do you see any evidence of people changing their behaviour as a result of the ESG metrics?
Yes, I think I do. So we, as I said at the beginning, we've been reporting ESG metrics to all of our clients this year, and that's sort of carbon emissions and a broader score on sort of social value creation. And what we're seeing is that it allows our client advisors to have a conversation with clients about their evolving views on sustainability. And I think social consciousness just in general in our society is increasing exponentially, and people really are recognizing the urgency of action to combat climate change, or indeed inequalities that have been absolutely accelerated by this horrible pandemic. And it feels like, particularly in our business, that this sort of acceleration in social consciousness means that more of our clients want to invest in a sustainable manner. And by presenting them with the evidence and the data around how they're currently invested and how they might want to choose to be invested, it creates the opportunity for those conversations and perhaps prompts changes in the way that they want to see their own wealth managed. And that's certainly the pattern that we're seeing.
Okay, thank you very much, Kate. Right, let's move on to our next question. So our next question is, how much confidence do you have in the underlying data quality and consistency? And do you think, or do you have any form of disclaimer in your reporting regarding data quality? And I'm going to kick off with Tim. And again, you're obviously not doing this on behalf of clients, but I'd like to see what PIMFA's perspective is on this.
I mean, I think our perspective of this is absolutely critical to get right, because, you know, garbage in, garbage out.
Yeah.
The old cliche goes. And I know it is a key part of what the FCA are trying to achieve, and a key part of what the government wants to be working on in the run up to COP26 at the end of this year, which is really about minimising the opportunities for greenwashing. And that is in part a data quality and data verifiability issue. So I think, you know, certainly we don't don't advise anything in particular about how you disclose information to clients. But I think we are supportive of efforts via the regulator and via the government to ensure that the data that goes into these models is high quality.
Okay, thank you very much. Patrick, do you have a view on data quality?
Yeah, look, I mean, I think in terms of our investment strategy, the underlying ESG data coming from a lot of the big data providers is fine, but it's not that useful for the kind of clients who are investing in our strategy, because actually what they're interested in is the climate transition and economic growth working for more people as investment theses, and they are prepared to compromise by investing in companies actually from a governance perspective which are probably less stringent than the wider market in some cases. And I think we all know key examples of companies that do that in the electric vehicle space, for example. So I think the data is absolutely fine, but I don't think it's necessarily a game changer for the types of clients investing in this type of innovation-focused service. And I think the data is pretty good, though, for a more kind of standard portfolio, which is more concerned with identifying kind of key environmental and social risks that perhaps they weren't aware of in investing in certain areas. So yeah, I think that there's a lot of kind of mud thrown at the data providers by people in our industry, and I think actually it's kind of useful for what you're using it for.
So Patrick, are the sort of ESG type measures that you would like the providers to provide that they don't do so at the moment?
No, I mean, look, I mean, the key message with this is a lot of this is self-reported. So you inherently come up with some quite odd scores. And I'll probably make another point, which is probably not everyone's going to like, but there are a crowd of people who want to tick an ESG box, but invest in exactly the same way that they were investing before. And there's a product range and a data analytic provider group which is providing exactly that. So I think you just, as a kind of specialist, need to know your way around that. I've got no issue whatsoever with the amount of data that I can get access to. And yeah, like I said, I think you just need to be, there are different investors trying to do different things with this. For some people, it's an investment thesis. For some people, it's about moral values. And for other people, it really is, and we have to be blunt about it, it is a kind of risk mitigation, reporting, tick box exercise that some clients want to engage in. And yeah, the different strokes for different folks.
Okay, thank you very much, Patrick. And Kate, same question to you, please.
Yeah, I sort of build on what Patrick was saying, actually. I mean, I think it's the difference between ESG and ESG risks and impact, sort of real world impact. Some of the data, so like the carbon emissions, for example, are quite well, you know, there's global frameworks, there's agreed metrics, you know, it's quite consistent data. Same thing for things like water intensity or waste intensity, you know, you can get pretty good coverage. But all of these things are backward looking statistics, or as Patrick said, sort of self-reported. And a lot of the ESG risk data is things like, do they have a policy that covers modern slavery? Do they have a policy that covers human rights? Yes, no. Does that, you know, yes, it mitigates the risks. Does it actually speak of how much or what they're actually doing? Possibly not. Examples I give, BAT, British American Tobacco, is one of the top 5 ESG rated stocks in the UK. Tesla, rated in the bottom 10% of all companies by one rating agency and gets an A grade from another. You know, the sort of inconsistencies in some of these ratings makes it really hard to navigate, and I'm pretty sure not what the end client expects. You know, for example, BAT to be in an ESG, a top rated ESG company. So I mean, I suppose from our perspective, how do we tackle that? Well, firstly, doing our own research so that you're combining the data with actual real life talking to companies and understanding the businesses. And secondly, thinking about it in terms of that impact, what's the actual outcome, meaningful outcome rather than just the ESG risks.
Okay, thank you, Kate. And I think that leads on to our next question. So Kate has talked about inconsistency in different data providers. And the next question is about how do you ensure that all client-facing staff are equipped to discuss additional metrics with clients? And Patrick, do you want to kick us off on that, please?
Yeah, I mean, I think there isn't really a good excuse for an investment professional or client-facing member of staff not being familiar with how ESG will or won't impact a client portfolio. And I think in terms of offering kind of client-facing staff exams, support, seminars, yeah, I mean, I think it's pretty much, it's a bit of a kind of qualification almost. I think that ultimately client-facing managers who don't have the right level of knowledge to do this at the moment, it's like not being able to use Zoom. You kind of, I think it's getting to that kind of point.
So have you run a program within Canaccord to equip your client-facing staff to do so?
Yeah, we have, and actually, to be blunt, I mean, I think the take-up, even from people that we were surprised, we've been surprised by the people who've really embraced it, actually. So,
right.
I think ultimately, I think people are predisposed to either really love or really hate ESG as a kind of concept. So if you can kind of get over people's prejudices kind of either way, and that's really helpful. Yeah.
Okay, thank you, Patrick. Let's go to Kate next. Again, how have you gone about equipping your client-facing staff to discuss such matters with clients?
Compulsory training is, I'm afraid, the route that we've gone down. I mean, we've gone down it in a number of ways. As Patrick says, some people are desperately keen and take real discretionary effort and go and learn all about it and want to be part of the change. Others are more reticent for various reasons, perhaps discomfort in talking about it, feeling like it's a different thing to what they've been used to talking about. And so we've come at it from a number of ways. We've done compulsory training, which is sort of online training. We've done group sessions. We've done sessions where we allow people to ask the stupid questions, and we've done one-to-one training as well. So we've crossed all things off the list. So I don't think there can be, as Patrick says, any excuses for people not to be able to talk about this to their clients in a I think one of the barriers to sustainable investing or ESG is the lexicon, the jargon. And I think the approach certainly that we're trying to take is to strip it right back. As you've heard me talk about meaningful impact, I'm talking about real world stuff that people can wrap their head around, normal people in the street that don't necessarily understand all the acronyms. And so that's the messaging to try and make sure it's consistent and that people can understand it, irrespective of their backgrounds. I think the only other thing I'd say is that for obviously an industry that is full of people that are very detail oriented and financially oriented, being able to set it in the context of an investment process and explain why this is something that offers a meaningful financial opportunity as well as a financial risk, unlocked some conversations that perhaps initially were more reticent about talking about these things.
Okay, thank you very much, Kate. And Tim, just to finish up, what's PIMFA's view on educating client-facing staff?
Yeah, I mean, I think it's absolutely critical. And one of the things I'm spending a lot of time talking to the regulator about at the moment is having a holistic view of their activity. And in fact, this morning I was talking to them about their consultation on duty of care. Now we are in this scenario that includes a whole host of proposals about outcomes-based regulation and how we communicate. And firms will find themselves in the position where they have a potential liability if they get this wrong. If customers believe they have made clear that they wanted ESG compliant investments and don't get them, or don't get them in the way that they were expecting, or are put into them without having approved it, and then potentially have a lower return for whatever reason, then firms will find themselves getting taken to the FOS. So it is absolutely clear, as this becomes a more and more important element of how customers make decisions, that all of your staff are aware of how to have these conversations with clients.
Okay, thank you very much, Tim. I'd love to continue asking more questions, but I'm afraid we've run very short on time. So I'd like to take this opportunity to thank Kate, Patrick and Tim, our panel members, and indeed Ian and Tim, our speakers earlier on. And can I have the next slide, please? So as I said earlier on, today's session will be, the recording of it and the slides will be put onto the Compare website over the next few days. But if you've got any specific questions that you want to ask about ESG reporting, please feel free to contact either myself or Ian, or indeed, if you would rather speak to PIMFA, here we've included Tim's contact details as well. So thank you for that. Can I have the next slide, please? I'd just like to mention our next few webinars, which we hope to see you again, see you at very soon. So we have a Compare event on ESG where we're talking about how to make the business case for ESG, and that's on the 15th of September. We then have a recruitment webinar about remuneration on the 30th of September. And then we have our regular Compare outsourcing event on the 13th of October coming up. So just to wrap up, I hope you've all found that very interesting. And as I said earlier on, please feel free to contact us if you have any questions. And I'd like to thank all the participants this afternoon. And I'd like to wish you all a great evening. Thank you very much and goodbye.